All right, welcome to the Risk Reversal Podcast. I'm Nathan, joined by Guy Adami. Guy, how are you?
What's up?
We got a lot to do today here. This is Wednesday, shortly after the opening. A lot going on. We had the president speak to a joint session of Congress last night. The economic agenda firmly part of the discussion here. So we're going to kind of go through that a little bit, how the market's reacting. I have a great conversation with my friend Ann Bordetsky. She is a partner over at NEA. That is a fabulous VC firm. We're going to kind of run through a bunch of stuff going on in generative AI, some of the investments they're making, how she's thinking about valuation and the like. So stick around for that. Also, a little housekeeping. I don't know if you've recognize this, Guy. You and I are turning on the mics and the cameras at 11 a.m. Monday through Thursday for the market call. We like the new time. Don't we like the new time here?
I do, and I think it gives people the opportunity to have more of the trading day ahead of them, whether it's 8 a.m. on the West Coast, 11 a.m. on the East Coast. Instead of a couple hours to trade, you have 4 or 5 or 6, depending on where you are. So yeah, we like the time change, and hopefully you folks like it as well.
Yeah, all right. Let's hit two things really before we get to my conversation with Ann. We just mentioned, obviously, the president spoke last night. I think the futures, at least the S&P futures, liked what had to be said there a little bit. I think that while it sounded like there was a lot of tough talk, Commerce Secretary Howard Lutnick maybe walked back the worst parts of these tariffs as it relates to Canada and Mexico. I don't think there was much mention about China. But Guy, one of the things that I think I'm taking away here, and I think this has been made evident over the last week or so, is that Canada and China are getting a little bit emboldened. And so I guess my question to you is, if we keep making these threats, we don't make clear ask for concessions, and then we keep kicking the can down the road, do these tariffs, or at least the negotiations, do they lack teeth, right? Or are we likely to see a more protracted sort of discussion or trade war if we really can't stick to the things that this is meant to accomplish?
I think that's the tightrope this administration is walking, because I think they want to implement these tariffs. I mean, they ran on this as one of sort of the pillars of their platform. And on the flip side, they obviously don't want to see the stock market under the pressure that we've seen. So I think what you're going to see going forward, is strong talk, depending on what happens with the market, a little bit of a maybe walk back to try to assuage some of the concerns of market participants, followed by strong talk again. Now, to your point about losing teeth, yeah, I think at a certain point, it's the boy that cried wolf for those types of things. And I think it may embolden China, Mexico, Canada to varying different degrees. But with that said, I think the overriding condition is they want to implement these tariffs in some way, shape, or form. And the hope is it doesn't cause the market disruption that we've maybe seen over the last couple of weeks.
Yeah, and I guess it's not just the market. Last night we had David Zervos of Jefferies on Fast Money, and he was making the case that he just doesn't think the tariffs are going to be that big a deal in the grand scheme of things. You're talking about the markets, but the way I'm thinking about it is I think the administration is playing a game of chicken with the U.S. economy, but possibly the global economy for political reasons, right? And so I just think it doesn't make a whole heck of a lot of sense. It makes sense to be a bit more thoughtful and kind of plan this thing out, because the on again, off again is the sort of thing that's causing uncertainty, which kind of brings us to this ADP report 2 days in front of the February jobs report. I mean, the ADP report came in half of what was expected, or less than that. So if the C-level suite has all this uncertainty, of course they're going to pull back on hiring. Of course they're going to pull back on CapEx and R&D and those sorts of things until they have some clarity with some of our biggest trading partners. We haven't even mentioned the EU yet, which he's talking very tough on. So again, the jobs report on Friday, does this have the potential to be a real market mover?
Well, I think so, but I'll say this as well. I think it's, regardless of administration, it's not, and I know you know this, and I know people listening know, but it's not like when you change administrations, you start from ground zero again. There's obviously a carryover effect. So to a certain extent, what we saw during the Biden administration carries over to this, and this will carry over to the next. So I think there's part of that going on. But your point about uncertainty, first of all, I think we all agree there's never any certainty about pretty much anything, but it's just the levels of uncertainty to the degree that are manifesting themselves. And I think that's where we find ourselves at this juncture. Your point is well taken. If you're an executive making decisions about hiring, my sense is you're going to be somewhat reticent until you know what sort of the landscape is and what the playing field looks like. And I do think the job market will deteriorate, whether this administration blames the last one or they take it on their own shoulders, I think is immaterial. I think the die was cast a long time ago. And I'm thinking we're starting to see sort of the effects of whatever we've seen over the last few years, if not longer.
Yeah, I mean, the blame game is what it is. It's very political, let's be clear, right? And I agree with you 100%, but I think it's also important to remember that some of the things that they're looking to cut, whether it be DOGE, whether it be to roll back some prior legislation, I mean, this is clearly hurting Trump voters. It's clearly targeting, some of these red states. If you look at Trump last night called the CHIPS Act of 2022 a horrible, horrible thing. They want to pull that back. That had $280 billion earmarked for new fabs here, R&D, a whole host of things. Really, and you've been making this point for years since the pandemic, that reshoring, production of semiconductors is a point of national security. And now with generative AI and the importance of that and it becoming like a sovereign arms race, not just on the private side of things, it seems very odd that that's the act that you'd want to pull back. Bipartisan, 24 Republicans in the Senate voted for it, and more than half of the money that was earmarked for the construction of fabs is in red states. So sooner or later, I think some of the folks in his own party, that would be Trump's own party, are going to probably have to start pushing back, especially if you start to see the economy deteriorating.
No, that's fair as well. I think you would agree, though, this is a president that is not going to be enamored by anything that took place in that prior administration. So regardless of whether or not it was bipartisan, regardless of whether or not it favors red states, if this is something that the Biden administration put into place, he's going to rail against it almost by definition, whether that's justified or not. But I think the better point is, or the stronger point is, at some point there's going to be blowback. And then you wonder how that manifests itself in some of the rhetoric, or more importantly, some of the things that we watch in terms of the market. And that's really sort of, I think, when the rubber hits the road, it's going to play out in bond yields. It's going to play out in commodities, and it's going to play out, almost more importantly, probably for people listening to this, in the equity market.
Yeah. So just to be clear, some of the things that got hit really hard over the last couple of days in the stock market are bouncing. GM, for instance, is up 4.5%. Ford's up 3%. So stuff in the industrial sort of space. So might we see some carve outs, right, for some different industries that are important here? And obviously, I mean, some of them that are, manufacturing and the like are important parts to the Republican caucus. What were a couple things that stuck out to me yesterday, Guy, was just the devastation in the banks. And to me, that obviously wasn't exactly the thing you could put your finger on that would be affected by tariffs, other than the fact that the tariffs and a trade war were likely to put pressure on the U.S. economy. Therefore, the banks, which have outperformed a good bit because of the hope of deregulation and tax cuts and all that sort of stuff, are basically seeing a lot of air come out of them in a very, very quick way. So I look at today on Wednesday, if the market's bouncing in just a little bit on the potential for a rollback of some of the worst parts of the tariffs, banks to me would kind of demonstrate investor appetite for, let's say, what the economic downside could be for a short trade war, I guess.
Well, I mean, for me, the banks comes down to this, and I think you would agree with me that banks are highly cyclical in nature, and they are not impervious to downturns in the economy. And we led this by talking about that ADP report. We'll obviously learn a lot more at the end of the week. We've talked about a potential for a negative GDP print. Banks don't win to those types of things. So regardless of what you think about deregulation, regardless of what you think about the yield curve, the M&A environment, the IPO environment, if things were to slow down in a meaningful way, banks won't win to that. And with some of the valuations that these banks have enjoyed and some of the runs that these stocks have had, I mean, they're not set up for that type of situation, I think. So yesterday's bank action made sense to me.
All right, last one. Oil weakness. It's down nearly 3% today. It's down about 18% just from its recent highs a couple months ago. Guy, at 66.5, it is at the bottom end of the range that you and I have been talking about since late 2022. A breakdown of this kind of 65 level, which I think is the multi-year low. Is it signaling some sort of deal as it relates to OPEC and getting more oil flowing, or is it signaling global growth weakness?
I think it's the latter. I think it's definitely signaling. I mean, I don't think at this point there's going to be any binding or important deal with OPEC. I think it's more the fact that there's this slowdown globally, but more importantly, potentially what's going on here in the United States in terms of that negative GDP print. So, crude oil is one of the most economically sensitive commodities that's out there, and it's trading in kind. And when you hear, drill, baby, drill, I mean, as much as people want to say that's bullish, it's actually, if you think about it by definition, if you create more supply, that's actually bearish, which is maybe what this administration wants. I'm not quite sure. I think there's a level of concern on a crude oil price. If it gets below a certain point, that actually hurts some of the producers here in the United States, but we might be in the sweet spot right now. But again, at a certain point, like an options trade, if it gets too low, then everybody starts to lose.
Yeah, no doubt. So the other ones that I'm watching are NVIDIA. I think that remains an important one. I think it was down maybe 28% at its lows yesterday from those recent highs. There's obviously a whole host of things that are wrapped up with the CHIPS Act and with China tariffs and all that sort of stuff, but also from a sentiment standpoint, the thing has barely seen an uptick since they reported. Is there any other sentiment sort of situations on a risk asset front? Bitcoin has bounced back. It's back towards that 90 sort of thing. We've talked a lot about these Trump trades that have round tripped the entire move since the election. Is there one other thing other than financials, which I know you're focused on, that you want to keep an eye on a day like today, where we're seeing a very, very slight bounce on the heels of that speech last night?
Yeah, well, I'll throw you a bit of a curveball. And for me, it comes in the form of dollar yen, which as we're sitting here is trading 148.60 or so, probably one of the lowest levels we've seen in quite some time. And if you folks want to go back to August of last year, you will recall that it was the move in the yen that sort of triggered that day on August 5th. And since then, we've had significant dollar strength, dollar yen went from about 139 back to about 160 or so. But we've been rolling over ever since the middle of January. And I don't think enough people are focused on this specifically, forgetting what happened in the summer of last year. So everything you said, I'm watching. I'll throw dollar yen in the mix as well.
I'm so glad you brought that up. The Dixie, the U.S. dollar index, in 3 trading days has gone from 107.60 to where it is right now, 104.5. That is a massive, massive move. And so dollar weakness is something you got to keep your eye on, because as you've said, careful what you wish for. This has come down commensurate with the 10-year yield, and it might be saying something very, very different than you know what I mean? A lot of folks might expect, as they say, oh, this is good for U.S. multinationals and the like. Well, it's not going to be good for U.S. multinationals if we're embedded in a big trade war. All right, Guy, we covered a lot of ground in a short amount of time. Check us out, 11 a.m. on The Market Call. Also, we have a newsletter, Guy. Where do you go to get that newsletter? Where do you go to sign up for that newsletter?
Well, I would go to the Risk Reversal website. I'm sure you can do it there, but I'm sure you can go to your favorite podcast store and those types of things.
I see what you just did there. No, go to riskreversal.com. The newsletter drops every afternoon after the close. Our market matrix is embedded in there. Our main man, CC, does a great recap of what happened in the day, the content that we did in the day, and what we're looking at going forward. So check that out. Stick around for my conversation with Ann Bordetsky, a partner at NEA, where we cover all things generative AI. All right, welcome to the Risk Reversal Podcast. I'm Dan Nathan. I'm joined by my friend Ann Bordetsky. She's a partner at NEA. Ann, welcome back to the pod.
Thank you. It's great to be back.
We have so much to talk about. I think you were last here in May, which is crazy, but we've had a lot happen in your space. And just to remind our listeners, you were making some very early investments in generative AI, and that's one of the reasons why we got to know each other in some really interesting companies. You and some of your colleagues just wrote a report, I want to say a few weeks ago, Tomorrow's Titans, Vertical AI. You wrote that with Tiffany Luck and James Kaplan. I want to go through some of that, some really interesting stuff in there. We also want to talk about, and you sent this article over to me from The Verge. I don't have the title, but it was Answer Engines and Platforms how they're taking a chunk out of traditional Google search. So we'll talk a little bit about that. Meta, Amazon, and Apple, they're duking it out. They're trying to find their way in consumer AI applications. So we'll talk a little bit about that. And then I want to know, how much would you pay for the domain AI.com? So we'll get a beat on that. So there you go. All right, let's talk a little bit about your post. Really in depth here. You use some kind of historical comparisons about just emerging technologies and kind of, how they came about and kind of what some of the outcomes were. And it wasn't always the easiest sort of guess in the beginning that you would have expected to be the winners of a new technological change. Let's talk a little bit about how you came about to write this piece about vertical AI. What were some of the major findings?
Yeah. Well, as investors, we're always thinking about how can value be created with AI, right? We're sort of in our third year of AI innovation at this point. It's been amazing to see horizontal winners like ChatGPT, like Perplexity, and other companies emerge. But now sort of the game has changed, right? Models are getting commoditized. That makes machine intelligence much more affordable, much more accessible. The market for developer tooling and AI foundation models has matured. So it's possible for developers to build more purpose-built specific applications. So the question is like, how do we take all of these tools? How do we create value, right? We're excited about vertical AI because we think industry-specific applications is where you can build some of the most fast-growing, defensible companies in this new era. And what is vertical AI? Vertical AI means using artificial intelligence, the foundation models, the LLM layer, the developer tooling to go solve actual customer problems in industries like architecture, construction, healthcare, you name it, defense, public safety. And so what's really exciting in these spaces is there's a lot of opportunity to automate different workflows, to access proprietary data sets, to use AI to make people's jobs easier and better every single day, and build around that a really interesting data network effect and a data moat that allows you to really make the product for that particular industry defensible over time. And, I think in the last sort of generation of big software winners, we saw a lot of companies that were systems of record, right? They were horizontal winners, Salesforce for CRM, Workday for, employee tooling, ADP for payroll, et cetera. I think in this era, we're going to see some really large winners that are taking services and labor and turning that into AI native software and tooling. And so, we can go deeper into it, but I think historically, vertical SaaS kind of got overlooked by the venture community because there was an assumption that maybe some of these companies wouldn't scale to the likes of Salesforce or Workday, et cetera. But now I think it's a very different attitude because investors are seeking areas of durability, defensibility, and where there are large kind of labor markets up for grabs that can be turned into software with AI.
Yeah, and so there's a really interesting point in the note here that just sticks out to me because when I think of Salesforce and I listen to Mark Benioff and he's kind of clearly moving towards this kind of agent model, right? And he's very critical of, let's say, Microsoft, how they use OpenAI and the idea of Copilot. So you have a point here. You say perfect storm of opportunity for vertical AI. While agentic AI capabilities are still in their infancy, we think there's confluence of factors that make it the right time right now to build a vertical AI disruptor. So you just mentioned some end markets, some verticals there. What do you guys, like, as you kind of broaden out a little bit in your search for the next company to kind of adopt, let's say this agentic approach and really tackle different industries, how are you thinking about that? Where do you think you're most going to be drawn to?
I think that in order to succeed in building a vertical AI company, an industry-specific company, a lot of things have to go right. But the key mix of ingredients that we look for is one, a founding team that really understands the customer in the industry, right? And it's such a great place for entrepreneurs. Like if you know a non-tech industry incredibly well, that is an advantage. You have to know the customer workflow. You have to know how these customers like to buy products, what it takes to establish trust and credibility with that particular customer. So domain knowledge, industry expertise is super important. And we look for that in the founding teams. The other is the ability to essentially ride the wave of AI innovation, build model agnostic applications where you know how to use the best of what OpenAI or Anthropic or Google or Microsoft, any of these companies are bringing to market, and use that to deliver a really phenomenal user experience, solving the customer's problem. And the third, I would say, is, I think this is an area where you don't need to be a research lab, but it is incredibly important to have a really great go-to-market playbook, right? That commercial acumen of how do we go become a category leader, become a recognized brand to these customers, and know how to sell into pretty complex environments and complex customers. So I think it's kind of a different mode. We've been, the last 2 years of investing in AI have been about finding the very best AI research teams, the very best AI engineering teams, and letting them build kind of the tools of this era. And that is still happening. But the shift to vertical AI means finding founders that can truly kind of sell into the particular industry that they're going after. And the difference between selling into healthcare and construction is obviously massive.
100%. And it just seems like a lot of those verticals industries, like healthcare, like you just mentioned, but it could be financial services, insurance. These are probably some of the first to be tackled. This was just coming out over the wires as you and I were speaking, that CoreWeave, which is a large NVIDIA customer, and some of their customers are some of the large hyperscalers. They're a huge buyer of GPUs. They're actually backed by NVIDIA. Also, they filed to go public, possibly with a $35 billion market value, raising $3 billion. And, the timing of this is really fascinating to me. We're in the throes of a pretty interesting sell-off in the public markets. NVIDIA is down 25% from its recent highs. Microsoft, Google, Amazon, they're all down more than 10%. Many are down 15% or so. So we're seeing this kind of distribution among investors of some of these early gains. And when you think about, the concentration of market cap gains in the public markets, it's basically been within 10 stocks. So that's kind of coming undone. You have a company like CoreWeave that just filed. It'd be interesting if they do make it to market, if we are in the midst of a proper kind of sell-off in this space that is protracted. And I'm just curious, because what you're an early stage investor, and you're betting on, you just mentioned it, you're betting on teams, you're betting on domain expertise, you're looking at the TAM, right? All this stuff, and you detail all of that in your report. How important are some of these public market dynamics to the way you're thinking about investing at such an early stage? And then we can also talk about some of the valuations, because I think Anthropic is in the process of raising at like $61 billion or something like that. I mean, some of these numbers are getting really big at a time where I think a lot of investor sentiment, at least in the public markets, might be waning after 2.5 bang up years.
Well, my relationship with the public markets is that I personally get paid to be a very patient, long-term investor. So I don't live and die by what, happens in the public markets every single day, but I do watch the long-term trends. And the way that it impacts early stage investing in the AI kind of ecosystem that's coming into existence right now, it's actually great to see so much confidence in publicly traded technology companies investing in AI R&D. Right? The fact that Google and Meta and Microsoft continue to commit larger and larger R&D budgets, both into AI foundation models as well as the data centers, the GPU centers, right? Where all of that is an investment that will lower the overall cost of AI intelligence and machine intelligence for all other companies that are building in the ecosystem. So I think less than the day-to-day variability, looking for kind of multi-year trends in R&D and CapEx commitments that these companies are making, and that continues to stay on trend. And I think there's a lot of confidence around that continuing to grow in the foreseeable future. But the other thing is the publicly traded companies today are so much bigger than the companies of the mobile era and the internet era. So I think as an investor, we do think about that a lot. We try to take that into account, even in the early stage investments of, when NVIDIA and Apple, are $2-3 trillion companies, the speed and the scale that technology companies today can achieve is so much greater than what we had assumed before. And now we're seeing companies like Cursor, for example, scale from 0 to 100 million in ARR in 3 years, right? Question we have to ask ourselves is how big can those companies become over time? Is it going to be a $10 billion company, $100 billion company? And so the size and growth of those, kind of AI winners in the public markets definitely colors our expectations and perspectives for how quick, how big some of these vertical AI winners can get.
Yeah, and I just worry a little bit about, just what you just mentioned about how big some of these massive incumbents are and their CapEx budgets, and it's been to the tune of hundreds of billions of dollars. They just kind of reiterated for the next year or so, it's going to be $300 billion if you just look at Amazon and Google and Microsoft and XAI and OpenAI, and now there's obviously Apple's jumping into the game. Who knows what they're going to do there? And I just wonder if that, the idea that these companies are overspending, they're telling you that they're overspending, they'd rather ask for forgiveness than permission. I just wonder if that is really going to create a bottleneck at some point in the private markets because, they have that leeway with their investors, but the public markets are also a daily voting machine. And we're seeing that right now, that investors are at least getting a bit more cautious about that spend. And I just wonder with some of the valuations that we're seeing, this is going back to a bunch of those names that you just mentioned, we just went through a period from 2020 to just recently where there were just all of these down rounds again and again. If the IPO calendar opens back up, there's going to be public down rounds. But the speed in which valuations skipped up, in this sort of wave, it just makes me a little nervous. But maybe I'm always a little nervous when it comes to markets.
I have a prediction around this. And I think we're in a little bit of a trust gap right now or a trough of disillusionment. And the reason it exists is there's all this R&D, CapEx spend, high valuations on the expectation of what AI companies will be able to do in terms of generating productivity, economic growth, reducing labor spend. But we haven't seen that really pull through to the revenue numbers for enterprise companies, maybe to significantly reduce labor spend. I think so far layoffs have been largely sort of, things that were already in motion pre-AI wave, right? They're not driven by automation that's coming from AI or AI agents. And so I think we're in this interim period right now where there's a lot of investment going in, but companies haven't yet seen the impact on their top line and their bottom line due to AI, but I think it's going to happen because we're still so early in adopting both AI models as well as the agentic layer AI agents that can augment human work and human labor. And I think 5 years from now, it's going to be a very different picture. It's just there's a little bit of a time gap between investment and ROI at the moment.
Which, by the way, was the same exact thing with the internet build in the late 90s into 2000. The stocks valuations, they got way ahead of themselves. And ironically, we went into this very large bear market, though, from, 2001 to the lows, and I want to say late 22. And obviously, the market started turning over in 2000. But a lot of it had to do with the fact that once this kind of CapEx and the excitement in and around the possibility of the internet kind of working its way through to all these different industries, it really kind of laid bare this whole idea that you can spend and not have the ROI on the other side of it. So to me, I think there's going to be a lot of similarities. I'm not suggesting that on the other side of the spend is a big, market crash or recession, but, history's rhyming just a little bit. And we'll see over the next few months just how much at NVIDIA, which is down 25% from its recent highs, how much it goes down. A lot of folks forget from the highs in 2021 to the lows in 22, Tesla, NVIDIA, Netflix, Meta, they sold off 70% in the public markets. Just think of that, right? And that was excitement in and around Meta and some of this other goofy stuff going on.
There is one thing that I think is different in this wave. or at least different in the way that I remember the internet and mobile eras, which is AI is also a strategic asset for this country. So, it's not just about ROI for enterprises adopting AI. We have to consider the fact that we're in an arms race, a global arms race when it comes to artificial intelligence, and we can't afford to lose. And so I think some of this has a geopolitical element and a national kind of strategic importance that will continue to kind of command greater R&D investment in localizing AI infrastructure in the United States, because being the global leader in AI also means economic power and soft power to influence the world. And I think that's sort of mixed in with the level of confidence in AI investments right now. But over time, I agree with you. Like, the ROI has to be there in terms of either consumer spending or enterprise spending for this to hold up.
No, that is actually a fantastic point. And so the idea of sovereign AI, and when you think about just DeepSeek, and again, this is more of a consumer application for all intents and purposes, but it really was a shot, across the bow for U.S. development, if you think about it, because, we were sitting here thinking all of these hundreds of billions of dollars in investment, the build out of these data centers and these amazing models and all the things that it's going to do here, that we were really in the catbird seat. And it also speaks to the fact that on the dais at the inauguration in Washington on January 20th was Jeff Bezos, Tim Cook, Mark Zuckerberg, Elon Musk. I mean, Sundar Pichai, Satya Nadella. I mean, think of that. I mean, that is a truly amazing thing. And it speaks to exactly what you are suggesting. Let's hit something here, because I think, given your proximity to companies like Perplexity, this was an interesting one that you kind of hit me on here. And it was this idea of, platform wariness. And so dig into this a little bit. This was an article in The Verge, and, it was basically saying that these answer engines, and then they use the term relevant platforms, but you use the example of a TikTok. These are something that folks are using every day and kind of addicted to. These really do have the potential to kind of displace some meaningful share as it relates to Google search.
Yeah, and kudos to the Verge team for putting out this great kind of consumer internet research study recently. There's a ton of great data there. I encourage people to read through it. But one of the things that showed up, they documented very well, this trend that we've been seeing for some time, even before the AI wave, of essentially the unbundling of Google. That's how I think of it. There was a time when Google represented the entire open web, and all of our interaction with the internet and digital communities was sort of funneled through Google. But even before AI kind of hit us, a number of things were starting to fall into place. One, Amazon was very successful in pulling away product search from Google. Then came along TikTok, and essentially both video, but also Gen Z started searching on TikTok, right? That's their preferred platform. And now, with the advent of AI answer engines, which include Perplexity, ChatGPT, and others, we're actually starting to see a very statistically significant trend of Gen Z and millennials beginning search not on Google, but in AI answer engines and other platforms. And if you look at the Verge data, 40 to 50% of Gen Z and millennials, right? And they're the ones who are really establishing the future of consumer internet, because these are the younger generations, are starting search on AI assistants and TikTok, not Google. And the confidence in Google being the arbiter of sort of internet information and a trusted source of information is plummeting as well. And so Google's doing a lot to try to catch up. They're still an amazing company, can't discount them. But, the reality is, we have to follow user behavior, consumer behavior, and consumers right now are voting with their feet and their clicks. And, those clicks are starting increasingly within AI answer engines. And the implications of that are pretty massive, right? Because it's also starting to show up in what brands and companies are seeing in terms of their traffic, their top of funnel. They're starting to see declines in top of funnel coming from Google. And, again, the new AI assistants and answer engines sort of driving more and more awareness for these brands.
Yeah, by the way, and I know this is, attached to SEO, and, some sites that I know, without naming names, their traffic's down 50%. Even if you go to Google and you get an overlay and it kind of gives you, this answer that doesn't look like 10 blue links, and if you trust the information enough and what it's telling you, you're not going to click through, right, to the website that it's citing. So that's obviously obviously Google's, that's their huge problem when you think about going to Perplexity. I mean, I usually start at Perplexity. I don't even know when I go to Google, you know what I mean, to do stuff, unless I'm looking for something on a Google map or something like that. So I can see how they have a real problem. But, this stock just a few weeks ago was trading at an all-time high. It's down now about 20%. What did they do? They raised their CapEx and they saw their revenue decelerate. And that's just not on, that was their overall business, but, Google Cloud also. And so investors are just not going to sit around and wait for more spend, decelerating revenue. And, this is something that obviously, like we just talked about, is playing out in the public markets here. I want to also hit this kind of, we haven't heard much about Amazon other than AWS and other about their investments and Anthropic, but this Alexa Plus, this is a new AI-enabled Alexa, we all know what it is getting like really good reviews. And then in Bloomberg today, it caused Mark Gurman, who's like the axe on Apple, just to compare what's going on at Amazon with this one device and this, obviously this platform, versus Apple Intelligence over there that was also going to be using another model that they didn't create. And, Apple initially last summer when they introduced Apple Intelligence, investors bought the crap out of it. They were saying this is going to cause an upgrade super cycle for the hardware. It didn't materialize. Now they're pushing out some of the major, kind of rollouts of product for intelligence to maybe June, to their next developers conference. I just think it's really interesting that this is playing out this way. I wouldn't be betting on Amazon, to be honest with you right now. And you don't have to bet on Apple. But the other one, and maybe I'll give it a three-pronged sort of thing here, is Meta and AI. We know that they have that little circle thing that goes in all their search boxes, whether it's WhatsApp or Instagram or Reels or the Blue Page or whatever. But they're talking about now spinning out a separate app for Meta AI. So when you think about those three names, do you have any thoughts? Who's winners, losers, this and that, or whatever? I think I know where you're going to go here, but I'm just curious your take right now.
This is the most fascinating race to watch right now. Like, it's truly a heated race for who's going to own the AI assistant market, which is massive, right? Recently, you've seen Meta, Google, ChatGPT all proclaim like race to 1 billion users. Who's going to get there first? But let's break it down a little bit. I think Amazon finally catching up and shipping a new version of Alexa, it was inevitable. Good on them for finally making it happen. There's so much at stake for Amazon here. They have been behind because they want to continue to own product search. They want to continue to own the home. And, Alexa's just like kind of been really dysfunctional for a long time. I remember when Perplexity first sort of came on the scene, we started using it. My own kids would ask me at home because we have the Alexa Echo in our kitchen. It's like a fifth member of the family. Oh, how come Alexa can't like communicate with Perplexity? Like they couldn't understand why it was so bad. But they are catching up with their Anthropic partnership. And so, but I think for Amazon, it'll be more around bundling this with Amazon Prime, making sure that that Prime membership continues to add value to consumers so they can maintain loyalty and, subscription revenue from Prime. I think Apple has really been behind and they're kind of a victim of their own success, right? They haven't been as willing to partner outside of maybe this OpenAI partnership. They're not really relying on third-party models. They're trying to build their own. And so, the fact that Siri is this far behind this late in the game is pretty embarrassing. And now it looks like it's getting pushed out to 2027. So I think even internally, if you chat to people at Apple, they kind of know that they're behind. They're a little bit embarrassed by it, to be honest. I'm sure there's a strategy at play, but it's interesting how far behind Apple has fallen. And that leaves room for companies like Perplexity and others to come in and partner with telco providers, with, exciting new hardware companies to launch AI native phones, AI native very affordable phones. And, Perplexity just announced today with Deutsche Telekom, essentially, a new phone that will have an AI native assistant and probably selling for less than $1,000. That's pretty good. Meta AI, I think, is not to be underestimated here. Zuck doesn't want to lose to Sam Altman. He's made that very, very clear. So I think they're going to be making big moves with this Meta AI app. But, in the context of having 3.3 billion users around the world, for Meta to put out any AI assistant that doesn't sort of exceed the scale of ChatGPT or get to 1 billion users pretty quickly is actually failure. So they're playing defense. I think we're looking at a more fragmented chessboard of big tech players all trying to see like who is going to be the winner among AI assistants. And I think that makes it possible for startups to stay in the game.
Yeah, all three of these are good examples, though, where they have massive distribution, right? To the point you think about Meta, and if people start getting used to using Meta AI as an app, because right now I don't think people are using it within these other apps that we're talking about, like Instagram and the like here. And then if you think about Apple, I mean, it would not take much for them to catch up when you think of an install base of 1.5 billion iOS devices around the world, right? And so if consumers are just starting to kind of figure this stuff out, and we know a lot of them are not paying for this sort of stuff, they're not paying for the pro versions, you can be a Google and you could be an Apple, or you can be an Amazon and play some catch up at some point, especially if all these models are pretty much going to be commoditized. So it really depends how it's integrated right into your product that you're selling to the customer. The other one, and this was in The Verge, and we'll put this in the show notes too, is that Google brings Gemini widgets to iPhone. And it kind of makes the point that you were just suggesting, is that, the device might not be that important, right? If you were able on a smartphone that is either working on 5G network or Wi-Fi, and you have these widgets on top of your iPhone and you just hit the Gemini button, like what's the difference? You don't need a Google Pixel, or you know what I mean? Like you can do it anywhere. And I think that's one of the areas where Google Gemini, it might not be the best model or the best interface, but, a lot of folks use Gmail. A lot of folks use YouTube. A lot, There's some platforms where, multi-billion people are on it and they're using, it's captured the attention of a lot of these users.
I mean, just big picture, there's 6 billion people on this planet today that have a mobile phone. That number keeps growing. I guarantee you all of them are going to want an amazing AI assistant on their phone. And, they're not all going to pay iPhone prices to get it, right? And so I think there's a lot of opportunity out there for the Android ecosystem and everybody who's building on Android to introduce low-cost AI native phones that essentially centralize the value in the AI intelligence versus the hardware, as you mentioned.
Which is also why I think DeepSeek was so important. It was important it came out of China. And even if it cost $100 million to train whatever, you don't need, not the 6. When you think about the the smartphone model in China, it really is based on low-priced Android phones with super apps like WeChat, right? And so you layer in a DeepSeek open source capability that app developers can build on top of, and you don't need to pay $1,300 for an iPhone, right? And especially in a country like China, where their economy is really weak and they're taking more nativist sort of views towards consumer products, where 5 years ago, they all wanted a Tesla and an iPhone. And if you look at market share, both those companies are losing share right now to those, the US sort of exports.
I was going to say, you mentioned WeChat, and I'm so glad that you did, because I think that same paradigm of a super app, WeChat was a super app for messaging and for commerce, right? It was essentially the mobile internet bundled into an app. I think we're going to see something analogous with AI assistants, but focused on productivity. So I do think one of the big trends is super apps focused on productivity. Again, these knowledge assistants, answer engines that are going to connect to all of your workplace apps. They're going to become increasingly kind of personalized and customized to you. And they'll be the place where you can write and search for information or analyze data versus having to go into, different applications. You're going to be able to do so much inside of a personal AI assistant that I think these are going to be the new super apps of the AI era.
All right, you want to hear about a super podcast? These are two of your portfolio companies. So we started Market Matrix. That's MRKT Matrix. Our team, we take about 10 of the most important business and market stories. Are you ready for this? Throughout the day, we have them summarized in Perplexity. We take the text. Our main gal here, Amanda, kind of threads them together a little bit. Then we put it into your other portfolio company, 11 Labs, and it reads it all out. And we have this 10-minute podcast. You don't have to listen to me speak anymore, because we call our voice bot Brunson. And it's just a great little wrap that comes out at the end of the day. What do you think of that? I mean, that's pretty cool, right?
I love that. This is the future of podcasting and media and content creation. And by the way, at the center of all assistants and digital experiences is voice. Voice is such a natural way for us to communicate, for human expression and communication. And now having voice as honestly a default modality for how we interact with computers and the internet and applications, it's such a game changer. I'm glad you guys are using 11 Labs. It's an amazing company.
Yeah, it's pretty cool. We enjoy it. All right, last thing. How much would you pay, or how much would you suggest one of your portfolio companies that just needed to have the domain AI.com? What do you think that goes for in this day and age?
Well, I would pay exactly zero. I'm going to be super controversial here. Here's my pitch. I wouldn't pay anything for AI.com because AI is going to be part of everything in the very, very near future. It'll be so, ubiquitous and available, and being just AI won't mean anything anymore. I think it has a very short shelf life.
I love that. Okay.
I'd bid $1. I'd bid $1 if you want to sell it.
So the market is $1 at $100 million because the information is reporting that the guy who owns the domain is trying to get OpenAI to pay $100 million for it. So yeah, I'll take the under closer to yours. Well, that's a great little half an hour that we just did there. I got a lot smarter, and I really appreciate you being here. I hope we won't wait months for you to come back to the pod.
I know, so much changes every single time. Thanks, Dan.
Thanks so much, Ann.
Always fun to talk to you.